Welcome everybody, I'm Joel Silverman at Silverman Law Office. Thank you for joining me today. Today is our fourth of 5 episodes in this tax planning webinar. So let's get right into it. What is today about? Today is about estate taxes, estate and gift taxes. So everybody is worried about paying the estate tax. I've already paid taxes once in my life. Why do I have to pay taxes again when I die? Well, the good news is that for 99.9 some percent, they don't have to pay an estate tax, or it's oftentimes coined the death tax. So we don't have to pay that. Why? Why do most of us, being 99.9% of us, not have to pay this? Because the exemption amount is currently over $11 million per person. I know you're sitting there, you're looking at this screen, me, and you're thinking, wow, I have no idea what he just said. What the heck is an $11 million lifetime exemption? Well, it's actually pretty simple. You can transfer at death up to $11 million to anybody tax-free. So if you don't have $11 million right now, there's no estate tax for you, no death tax, nothing to be scared of, unless in 2023, the government doesn't fix the law that they just created in 2018. If the government doesn't fix the law in 2023, then that means we're going to revert back to what it was in 2008, which is $5 million per person, which that $5 million exemption per person, that exempts 99.1% of the public from ever paying the estate tax or death tax. So again, pretty small group that it affects as a whole, but you need to be aware of it. And so now you ask, well, geez, Joel, if there isn't really an estate tax for the majority of people, why do I care? You care because it affects your income taxes. And now you're really looking puzzled at me. I can see it. I know it. It's right here, okay? Because I'd be looking the same way. How the heck does an estate tax turn to an income tax? Well, it does if you don't plan it properly. So what happens is when we pass away and we own an asset, and that asset transfers at our death, that asset gets a step up in basis. Now I know you're really thinking, what are all these terms? Step up in basis? What's basis? Basis is basically what you pay for something. If you buy a house for $200,000, that's your basis. Now there are things that can affect your basis, raise it up, lower it down, but we're not going to get into that. Now, if you sell that house for more than $200,000, you have a gain, which is the difference between what you sell it for and what you bought it for. So, for most of us, we have things like stocks, investment accounts. We have assets like maybe our home or a rental property. If we give those items away before we pass away, the problem is we don't get the step up in basis. And so if you pass an asset, let's say you bought a rental property for $200,000, you gift it to your kids, it's now worth $400,000, and your kids turn around and sell it. They're going to pay tax on the difference between what they sold it for and what your basis was in that property. So easy numbers, $400,000 sale price, you bought it for $200,000, they're going to pay taxable gain on that $200,000 gain, the difference between sales price and what you bought it for. Easy way to explain it, okay? Simple example. Now, you say, okay, but how does that really affect me? Well, it affects not you, but your kids. So if you gift items away before you pass away, no step up in basis. However, now take the same example. You bought the rental property, $200,000. You pass away and you still own it. And you transfer it to your kids in one of many ways, which if you go and look at our estate planning webinar, you'll learn how to transfer assets. But you transfer that house at your death, and it goes to your kids. Your kids can get an appraisal done on the property to show that it is worth $400,000. They sell it for $400,000, and they will pay zero tax on the sale of that property. In my simple example, zero tax versus probably about $60,000 in tax. That's a big number. And there's easy ways to plan for that. That's just the most basic example in estate planning and how that affects things. But taxes don't always control everything. You might be concerned about a long-term care facility, which nowadays most long-term care facilities, on average, $8,000 a month. That's a high cost. However, what if you know you're going to be saving hundreds of thousands in taxes by holding the asset until you pass away rather than transferring it now while you're alive to your kids, and then your kids can pay for your long-term care? Just dealt with this with a ranch family. They were looking at transferring the ranch because somebody had advised them that's how they could get out of the long-term care prospects of paying for it. And we came in, we were able to fix that for them. We were able to save the family over $150,000 in taxes that they would have paid if mom had passed away without owning the ranch any longer. So there are huge differences. Another thing that affects too. Let's say you say, okay, Joel, well, I have an asset. My kids don't want to sell it though. They want to keep it. Great, let's go back to the rental property. So you pass away holding your rental property. You own it. $200,000 is what you bought it for. Well, your kids are still going to get the step up in basis to $400,000. Here's the beauty of this. Now your kids get to redepreciate the building that you've already depreciated, saving them hundreds of thousands of dollars in income taxes, right? So there's lots of ways that you can plan to make things happen the right way. That's what we're here for. Other than that, you've got to remember that taxes don't always control everything. And when it comes to estate planning, taxes are key, but it's not about the estate tax, it's about the income tax. One last area to talk about. We want to talk about the difference between a trust and how it's taxed versus a will or a basic type of estate planning with a will. So a trust is like a will, but it's a contract in essence with yourself. And there are two types, basic types, if you will. There's the revocable and irrevocable. A revocable trust is an extension of yourself. It doesn't pay taxes while you're alive. When you pass away, it may become irrevocable, and you may then have to pay taxes. The trust may have to pay the taxes at that point, but it all depends on how it's set up, okay? An irrevocable trust, when you create an irrevocable trust, it is no longer an extension of you, it's like a company. So if you set an irrevocable trust up and it has income, it earns income, that irrevocable trust pays its own taxes. You got to be careful of that because it pays its own taxes at the highest rate and pays them faster than you would ordinarily. So be very careful. So I also get the question, what do I do if I have a taxable estate? Well, number one, if you have a taxable estate, if you're worth more than the $11 million, get in and see us today. We can help with that. We can help minimize it. We can help strategize it. We can put something together. What are some of the tools? Some of the tools are life insurance. Life insurance is the number one tool for minimizing your estate tax. Number two, lifetime gifting. Giving away highly appreciable assets while you're alive to reduce the value, overall value of your estate. So how do you put all that together? You start planning now. You give us a call today. If you give us a call today and you set up a consultation, mention to them that you watch this webinar. We're going to give you the first 30 minutes free of that consultation. So give us a call. We'll get your tax book today. If you also ask for our estate planning book, we'll get you that too for free. We're not even going to charge you for the shipping, but you've got to call and ask today. Thank you. I'm Joel Silverman. I appreciate you spending some time with me today. Go to our website, mttaxlaw.com. You'll see all our videos there. Go on to YouTube. We've got a bunch of videos there on various topics from estate planning to tax to liquor and gaming law. We're here to help. We love helping people. It's what drives us every day to show up. Every Monday, we're here early because we love doing what we do. We hope you do too. Thank you. Have a great day. We're going to give you a special offer where if you mention to our team that you watched this webinar series, we're going to give you 50% off on your initial consultation. So give us a call today. Don't hesitate. We look forward to meeting with you and helping you and your family achieve everything you hope.